Welcome back. Well, the market is all over the place, really. Now it's absolutely quiet, but there are those tumultuous moves that you're seeing, just consolidating around 18,000 levels. December auto sales indicated a big jump in the commercial vehicle sector due to the return of infrastructure demand and resumption of bus sales due to offices and schools reopening. Also, the CESL tender discovered that it's 29% cheaper prices for electric buses versus diesel ones. So what are the opportunity for the bus sector, especially in the electric vehicle space, and what's the outlook for commercial vehicles? We have Vinod Agarwal, Managing Director and Chief Executive Officer of Volvo Eicher Commercial Vehicles at Eicher Motors, and Jay Kale, the Senior Vice President Research at Elara Capital, joining in. Gentlemen, morning to both of you. Happy New Year and hope you have a great year. Mr. Agarwal, I want to start with you. The month of December was very strong, even for Eicher Motors in the commercial vehicle segment. Good jump both year on year and month on month. Tell us a little bit about where the demand has come in from and what do you see as a sustainable growth?
Absolutely. I think the month of December was very good for the industry as a whole and also for our company, VCV. As you know, I had been mentioning that earlier also that we are going to see good growth in the CV industry because now CV industry is on the recovery phase after 2-3 years of recession, and this recovery is absolutely in line with our expectations, and of course we are still away from the earlier peak levels. So therefore, there is still more room for recovery. So we will see more recovery coming in this, especially in the bus sector as well as the heavy-duty trucks. But some of the sectors like medium-duty trucks or small commercial vehicles, there already we might see the new peak in the current year itself. So therefore,
all right. So could you just help us with some numbers when you say new peak? You know, if you look at the last 8 months, the run rate has improved quite a bit. I mean, this time the wholesale numbers have crossed 7,000 units. You haven't seen that at least in the last 12 months. What could the new peak be? What is the average monthly run rate? And on the retail front, what are you clocking in?
If you look at the numbers, when I say new peak, if you look at, say, 5 to 15 ton industry. 5 to 15 ton industry, earlier peak was 118,000 in the year 2018-19. Now this year, first 9 months, this industry is already at 88,000, 5 to 15 ton. Now last year, the quarter 4, Jan to March, it was around 37,000. So if you assume that there will be some growth on that 37,000, and if you add that to 88,000, that has already happened, you arrive a figure which will be a new peak in the current year as far as this 5 to 15 ton is concerned. Similarly, sub 3.5, there will be new peak because already we are going to cross the earlier figures of 1890. However, if you look at the buses sector, in the bus segment, the earlier peak was around 70,000. Now this year, already, if you look at the numbers, in the bus sector, we are at 9 months at 40,000. And last year, first 9 months was only 9,000. Now this year, the industry in the balance 3 months, we expect to be another around 17 to 18,000. So we will be at, say, 58,000 for the industry. Now that will be still away from the earlier peak of 70,000. Similarly, if you look at the heavy-duty trucks, the earlier peak was 200. The heavy-duty trucks was it was 295,000. Now this year we have already reached in the first 9 months 165,000. So still it will be, if you add the balance 3 months, it will be away from the earlier. So some segments new peak, some segments still away from the.
All right, Mr. Agarwal, you're sounding reasonably optimistic, and the hope is that FY24, getting into an election year, hopefully the CV industry continues to do well and maybe breach the FY19 peaks that we saw. Let's get a couple of numbers going then. First 9 months you've done rather well. The growth is close to around, I think, 40% on a low base. For the remainder of this year as well as for FY24, what kind of a volume growth can you do? And I just wanted to quiz you, exports are a small part of your business. But there has been pain, if I look at it on a December to December basis, even in the first 9 months, there's a sharp degrowth out there. What's your sense out there?
The exports, the entire exports out of the country, that is under stress for the entire industry, because there is a severe foreign exchange shortage in some of the South Asian countries. And that is leading to very low export to those countries. And exports, if you look at as an industry, the exports for the commercial vehicles, that has dropped by almost 18% in first 9 months, whereas the entire domestic sales are growing by 49%. The exports have dropped by 18%. So therefore, exports is a concern area for the entire industry, and in line with that, our exports also have come down.
Okay. Mr. Agarwal, do stay on. Jay Kale is also with us. Good morning, Jay. Thank you for your patience. Where do you think we are in the, CV cycle? It normally runs in 3 years, doesn't it? So, do we still have a goodish bit to go?
Yeah, good morning, Lata. I wish you a very happy new year.
Thank you.
Yeah, so, like Vinod, you mentioned, CV industry has, been on a improving trend in the last few months, specifically also in December, we saw strong numbers from the industry. The way we look at it is, if I have to evaluate the M&HCV industry, which is, as per CM classification, anything above GVW of 7.5 ton, we had seen a peak of 3,90,000 units or the domestic volumes in FY19. And if you see, historically, it's been a 6-year cycle from peak to peak. The earlier peak was in FY12, which was crossed in FY19. Our expectation is that the next peak of FY19 will be crossed in FY25. So we still expect a double-digit growth in FY24. And the confidence of the double-digit growth has, in fact, only strengthened with the last few months of strong sales. The infrastructure segment has picked up. Some bit of December was also, in our view, helped by the impending price hikes that were expected to come in Jan. We need to watch out for how the transition to the RD norms happens from April, and hence the rationalization of inventory in Q4. But those are transitionary issues. Overall, I think we are expecting FY19 volume peaks to be crossed in FY25. So we will see a good double-digit growth in FY24 as well for the M&HCV industry.
Okay. Mr. Agarwal, I wanted your thoughts on the market share update. What is it so far, year to date? And is there any segment, because buses are picking up in a big way. There's a lot of talk from the CESL, tender ordering as well for EV buses. Your own market share in the bus segment has gone up as per the last quarter. So tell us, across the board, where are you gaining market share and what is the prognosis now?
We are improving market share in all the segments. If you look at heavy-duty trucks, in heavy-duty trucks, our market share is now more than 8% for the first 9 months, both for the Eicher and Volvo trucks. And if you look at the light and medium-duty trucks, our market share is 30% plus, which is almost equal to the last year's market share. And if you look at the buses, our market share is now around 25%, which is much more than the earlier market share of around 19-20%. So we have improved market share in heavy-duty trucks as well as in the buses segment. However, the market share in the light and medium-duty trucks is flat at around 30%.
Okay, all right. Mr. Agarwal, the cycle seems to be turning and we seem to be seeing strength in the CV cycle. Then what's happening on the discounting front? Do they still exist? Are they narrowing?
I think there is a lot of realization all across, and because if you look at the bottom lines are under severe stress because of the high discounting, and there is realization at all the companies levels. If you look at previous announcements, of course, we at VECV always wanted to control the discounts, and we are trying our best to cut down the discounts. However, it is a competitive situation, and because everyone has its own strategy, each company.
Yeah, Mr. Agarwal, you want to give us a couple of numbers? What were the discounting? What has it come down to?
These are no fixed numbers. There is no fixed number that so much is the discount. It is always deal to deal based. There is no such.
Okay. You also mentioned earlier that the segment market share in the bus segment has risen to 25%, higher than what it was earlier. I wanted your thoughts on what is the opportunity for electric vehicle bus makers, for companies like yours, considering that this CESL tender is quite big and now they've discovered much cheaper prices for EV buses compared to diesel and petrol. What is the opportunity here, sir?
First of all, the electric buses, the industry is evolving, and this is just the beginning of the volumes. And this is the second tender which was run by CESL. And of course, the current model, business model, which is there by CESL, this is a very, very challenging model for the entire industry. As you would have seen in the last tender, in fact, 2-3 large companies, they didn't participate. We also didn't participate because this model is for at a GCC model where the OEMs have to fund these buses for 12 years. It means the OEMs don't get the money against sale of these buses. So you have to realize on per kilometer basis for next 12 years. It indirectly means you are giving the loan to state transport undertakings, because these buses are going to be run for state transport undertakings and companies are going to take the risk on their balance sheet. So it means I am supposed to raise the loan on my balance sheet for 12 years for selling these buses to STUs. So that is why this model is very, very challenging. And of course, the last tender has been successful. And I have seen the announcement that there has been reduction in the costs. But at the same time, it is going to be very, very challenging for the entire industry if the model continues like this.
Okay. So, Jay, what is your thought on this? Do you think the way the EV bus ecosystem is evolving, this can disrupt existing players, or do you think the ordering will change?
I think, see, these are, I totally second Vinodji on this. These are initial days on the EV buses side. The pricing is yet to be evolved. There will be a time frame, of course, like you mentioned, that 10 to 12 years is a long time for the OEM manufacturers to take these vehicles on books. And mind you, what I understand is that the inflationary pressures are also of the operating these buses are also built into this per kilometer pricing. So these are quite competitive prices. I think as we move forward, there's a lot of STUs which are expected to turn into EVs. And as we move forward, this, OEMs will realize, and the price discovery on real operations and the challenges in really operating these vehicles on road will be known. And then eventually a lot of shift of market share could also happen basis the experience of the existing OEMs who build, and eventually, these prices could get adjusted. But for the moment, in our view, these are extremely competitive prices for the kind of issues that could also come in going forward in operating these buses. But still early days, I would say.
Okay. Would you scale down your earnings estimate for the sector as a whole, Jay? Because A, demand is under pressure. B, you have the new emission fuel safety norms as well that are coming through from April. So that may hit demand further. Would you scale down your earnings estimates?
So, it's different for different segments. So, for example, in the last couple of months, CV segment, I don't see any downgrades over there. In fact, if at all, there would be minor upgrades on FY23 numbers. Not so much on FY24 because our expectation has not changed for the absolute numbers that we expect for FY24. So, CV segment and tractor segment, no really change in numbers. If at all, some upgrades as well. Passenger vehicles, because of the chip shortage, we have seen some bit of downgrades, but very minor downgrades in FY23, and some bit of pressure on the entry-level segment. And two-wheelers, of course, we were relatively lower in terms of the volume growth expectation in FY23. Demand is slightly soft at the rural side, post fag end of the festive season where demand kind of improved. In December, we saw again a softness in demand. So, PV and two-wheeler may be minor downgrades, but not so much in CVs and tractors.
All right, we'll leave it at that. Jay and Mr. Agarwal, thank you very much indeed for joining us and giving us a 360-degree perspective of the CV sector and the bus sector. Have a fabulous 23. Okay, we now move on to another company that's in the limelight. Castrol India is the one we're going to speak to on the news that the company has entered an agreement to acquire around 7% stake in Key Mobility for a total consideration of 487 crore. To alert our viewers, we understand that KI or Key Mobility is a part of the TVS group and is among the leading players in the auto service, maintenance and repair space. To discuss more on this, we are joined by Sandeep Sangwan, Managing Director at Castrol India. Good morning, Mr. Sangwan. Thank you very much. It is Key Mobility, isn't it? I mean, that's the way to pronounce it. Okay.
Yeah. Hi. Morning.
Good morning. Okay, I just wanted to understand what are your plans for taking this 7%? What's the longer term, strategy behind this?
So first of all, thanks for inviting me on your channel and wishing all our viewers a very happy New Year. And I think if you look at our investment in Key Mobility, this is the first time Castrol India has made such a move because the ecosystem is transitioning very fast, especially as far as the independent aftermarket is concerned. And by coming together of My TVS, which is the brand Key Mobility goes with from a consumer-facing, customer-facing propositions, and Castrol, which is a trusted brand by consumers and customers, which has been in India for last 100 years, I think there are many synergies to step change the aftermarket ecosystem to give customers and consumers a better experience. And also as the ecosystem transitions to EVs as well. I think, so that's the broad thinking because Key Mobility being part of TVS Group is focused on building a business for the future. Castrol is looking at opportunities to transition to an EV world and participate with like-minded players in the market. So that's the broad theme.
Okay, all right. Hi, Sandeep, if you could give us a few more details. We currently have that of 7% is what you're looking at for around 480 crores odd. Will you look at buying more stake? And this initial transaction will get concluded in January 2023?
Yeah, so thanks for the question. The transaction will get concluded in Jan 23. As far as the future is concerned, I think it's very early to speculate anything. I think our focus right now would be on creating value from the synergies that we have currently. And I think we will focus on that going forward, especially as far as 23 is concerned, and then we'll see how things go.
There's a lot of focus now on this entire electric vehicle space, on the EV supply chain as well. It's a shift for you away from your traditional products. So tell us a little bit about what the next 1 to 2 years would look like. How will you secure, yourself in this whole EV supply chain? How much capex are you willing to put on board?
So I think let me kind of share a few details. Castrol is very active in the EV space. So first of all, we work with a lot of many of the global OEMs, but also OEMs in India, such as Tata Motors, MG Motors, Renault, on the EV fluids. We supply EV fluids to them. And there's a lot of global partnerships that we are working on. So that's one. The second is we're also very excited. This quarter, we'll be launching something called Castrol On, which is a range of EV fluids for the retail market. It includes transmission fluids, greases, coolants, and that'll come into the market this year. The third area, I think you mentioned CapEx. We are part of BP, which is a multinational. And if you maybe you would recall, last year in the second half, BP announced that we would be investing about 500 crores in a battery thermal management facility, R&D facility in our global headquarters in Pangbourne, UK, to which Castrol India will have access, because I think battery thermal management is emerging as a key issue as people look to far more efficient batteries for extending range. And that's one of the key pain points that we want to try and address as Castrol. So Castrol India will have access to all that development happening in UK. Plus, we're also working with some of the two-wheeler OEMs in India, trying to address their challenges around battery thermal management. The other angle that I would say is we are also getting very active in service and maintenance space, and making the service and maintenance ecosystem in India EV ready. For example, we've just launched a program last quarter with the Automotive Skill Development Council of India, where we're training aftermarket mechanics to be EV ready from a maintenance perspective. So we've trained almost about 400 mechanics so far between Delhi and Chennai, which are the hot markets from EV perspective. So a lot going on in different spheres of EV and positioning Castrol as a EV future ready company.
Okay, now one can see that, Mr. Sangwan, that you want to diversify your risks away from just a fossil fuel exposure. But, you know, that kind of diversification and investments would come at a cost. Do you see, at least in the near term, any impact on your margins? I think you did operating profit margins of about 23% in the last reported quarter. Can there be pressure in the near term?
So I think, first of all, we have a very healthy balance sheet to fund our requirements from a capex perspective. The second is, I think, in 2022, because we operate Jan to December financial year, the pressure on margin was primarily on account of the input cost inflation that we've seen in the supply side shortages and shocks that the world is seeing. And that impacted our margin by a couple of points. But I think going forward, our intent is to keep our healthy margins. As you said, quarter three was about 23%. If I look at 3 quarters of 2022, we are at about 24% EBITDA margin. And our view is to protect those margins and continue investing behind our brand and business.
I think the last time we spoke about 23 to 25% margin band, so I think you're working towards that. What about volumes? Give us a sense of 2023. What kind of a volume outlook are you looking at? And also break it up for us, your mix of automotive versus industrial. What's the current mix and how is that likely to change?
Okay, so if you look at the market growth for 23, our estimate is that the lubricants market will grow at about 4%. Primarily driven by personal vehicles. We expect cars to grow at about 8%, two-wheelers to grow at about 4%, and then commercial vehicles will also grow. And our intent is always to grow ahead of the market, and you can put the numbers together. If the market is growing at 4%, we'll possibly be growing 1 or 2% higher than that. That's one. Sorry, Nigel, can you repeat your second part of the question?
What is the difference? You know, currently your contribution coming in from both the segments, automotive and industrial.
Yeah, so industrial is about 10% of our business, 10 to 12% of our business. Primarily, we are an automotive focused business, but industrial is also growing. But we participate only in specialized sectors around high performance lubricants, which help make manufacturing more efficient. And I think if I look at 23, the mix is primarily going to stay the same. I don't see any huge differences or any huge changes.
Okay, all right, we will let you go on that note. Thanks a lot for joining in. Let's take a quick break though on the market. Lots of individual stocks in focus, so we'll come back with that. Mitesh Thakkar will also join in for some technical trades, so do stay tuned in.
Welcome back. Well, while we were engrossed in the heavy commercial vehicles and the EV buses conversation, the market has actually walked back a little. A distinct sell-off in the bank Nifty, actually down 0.5% at this point in time. And the Sensex and the Nifty have also given up early gains. Any effort to buy the dip has not succeeded as of now. So Mitesh Thakkar is the man of the hour. Mitesh, what do you do with the Nifty and the Nifty bank now?
So, Lata, I think, as I said, the overall bias is slightly on the negative side, and Nifty, I think once it breaks 18,000 and we are only about 15, 16 points away, then I think I would want to go short. Keep days high as the stop loss, and I think 17,800, the lows which was made in sometime around 23rd of December, I think that could be revisited. So that's the minimum which I would look for, maybe a decline below that as well. Similarly, on the bank Nifty as well, I think, there is an intraday sell signal being generated. So keeping a stop at about 43,000, I think short positions can be taken once 18,000 goes away on the Nifty. And then I think a decline to about 42,000, 42,200 could happen. So that range is the minimum target which I'm looking at. So negative on the markets. On the stock side as well, I have,
No, go ahead.
Sure. So Power Grid is a sell. I think that's the stock which is breaking and expanding on the negative side. Keep a stop just above levels of 211 here, and a target of around 195 can be looked at. The other one, which I think is possibly turning negative, is PVR. So here, keeping a tight stop at about 1712 and a target of around 1620 on the downside is what I'm looking at.
Okay, thanks a lot for that. Well, let's shift focus to the commodity markets now. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Sonia, it's very rare that you start a year by saying that this is what has happened in the first week of the year. I mean, usually the markets are still down and about, volumes are low, people are still not participating, but so much has happened in the first week of January already in 2023. Take a look at the crude oil prices, and the first week itself will show you on the kind of move that we already have seen. So the crude oil prices overnight fell by 5%. In last two sessions, we've seen 10% of a decline, and for the week as well, we are trading in the negative already there. This is what we've done in 2023 so far. We haven't even gone through the first week yet, but 8% of a decline in Brent crude. Natural gas is 12% down. The Europe gas price is down by 20%. There is absolutely no winter there, and the heating oil prices have declined by 8% as well. And whatever requirement that there is for gas is actually getting completed by wind power in sense of electricity generation, and that is the reason you have complete decline in prices there. There is weak global demand outlook that continues to weigh onto the markets. The Chinese rising COVID cases, the death toll that has been rising also weighs on. And then China has raised the export quota for refined oil. That is because the domestic demand is expected to be on the weaker side for the first quarter of this year. The markets also are looking at the U.S. crude inventory surging by 3.3 million. The last 2 weeks saw a decline. This week, the expectation is that we are looking at a build-up. And then the OPEC December crude production also has increased vis-a-vis the month of November by nearly 150,000 barrels there. Markets also are looking at the fact that the Saudi Arabia has cut the Feb prices for Asia by nearly to a record, really lowest in the 10 months. And then we also have the manufacturing numbers for China and US coming on the weaker side. And now the markets will watch out for what Russia and OPEC allies will do going forward. So everywhere that you look, we are looking at weaker demand, concerns about slowdown, and that is what is weighing onto the markets there. Same is the case with the gas prices, where we are looking at very sharp cuts coming in. In last 5 trading sessions, we've seen 25% of a decline. Today in the Asian markets, we saw 5% of a jump up coming in as well. That is because the markets were oversold. We had seen 25% of decline already. So we are trading at just about $4 right now. December was $7, and we saw $10 of a multi-year high in the month of August. So it has been a constant decline, as you can see in sense of prices. And that is because we're looking at mild winter in January in US and Europe. We are also looking at Europe gas prices lowest since October 2021. So not just pre-invasion levels, but we are looking at multi-year lows now right now in sense of gas prices. So much so that we're down 52% now since mid-December in sense of Europe gas prices there. Increased power generation, as I said, from wind really seems to be the case here. And then there is absolutely lower demand. And, you know, usually in Europe and in Germany, by December and January, 70% of their capacity are filled with gas. This time around, they actually hogged it all in anticipation that Russia perhaps could stop exports. So they are holding around 80 to 90% of capacity in sense of gas. And the demand clearly is on the weaker side. With prices as well declining, the markets do believe that there is some more downside coming in here. Most banks and brokerages feel that for the month of January, you could be looking at lower lows, and 3.5 perhaps is a possibility here. Also watch out for the US non-farm payroll data on Friday. That is the next big cue coming in.
Okay. Well, the bulls may be sad about it, but here there are only oil bears. We welcome them from a national standpoint. Thank you very much for that very detailed analysis, Manisha. We veer over to the stock market, where one of the most shocking performances are coming from the Bajaj Finance share. I can't remember when in the last 20 years, 25 years of covering stock markets, this storied stock saw a 7% fall in the first hour of trade. Abhishek to tell us what caused this. Go on, Abhishek.
Well, brokerages have written on Bajaj Finance, so the AUM growth that has come in at 27% YOY is below their estimate. However, customer additions have remained strong, and number of loan books is in line with what analysts were estimating. So the growth has slowed down sequentially. Q3 is usually a strong quarter for the company. However, this time around, it has not been that strong. So Q on Q, due to festival growth, Q3 is always expected to have a strong growth. This time around, it's the lowest growth that you are seeing in Q3 of a fiscal in last 10 years. So either there was some festival impact at the end of 2Q, or the company has lost market share is what the brokerages are saying. They see loan growth moderating going ahead as well. We have Macquarie, who has an underperformance rating with a target price of 5,275 per share, and also CLSA with a sell rating and a target price of 6,000 per share. Back to you.
Okay, thanks a lot for that. HPCL also on our radar. Sonal is here to tell us why. Sonal, over to you. Thanks a lot for that. Well, yes, crude prices falling, the biggest benefit that we are seeing on the oil marketing companies, and HPCL amongst them is the biggest gainer. Second half of FY23 for oil marketing companies as a whole is expected to be much better than the first half, where these companies saw massive losses, and that's why there is an improvement in marketing earnings which is expected for all these companies. There is more individual news for HPCL as well. I'll come back to that later. But in terms of marketing earnings, they are expected to see a massive gain. They did made losses. For instance, IOC at 28,000 crore rupees, BPCL 18,000 crore rupees, HPCL around 16,500 crore rupees. These are just the losses in the marketing segment. And according to ICICI Securities, there will be a massive upgrade in the second half, and they expect crude to range between $80 to $85 per barrel. And now crude prices have come in even lower, so there could be an upside to these estimates as well on marketing earnings. Now, HPCL benefits the most because they have the highest exposure in the marketing segment coming in for their revenues and EBITDA. Additionally, HPCL has forayed into the petrochemicals business, and the refinery will be setting up a capacity of around 9 million tons per annum in terms of capacity expansion there. Additionally, they have signed an MOU with NTPC Green Energy Limited, and this is with respect to renewable energy. They are looking at expansion in energy storage projects, RTC power, electric mobility, solar, wind value chain. So a lot of capex will go into green energy as well from HPCL. All these factors leading the stock higher in trade.
Oh, yes, so it is. Thank you very much. It's about 2% higher. Thank you very much, Sunal. So some people betting that crude will remain lower, and others telling us that that's only in the near term. So let's see. We have to take a break, and on the other side, it's our special segment. It's the economy. I'll be chatting with Steve Englander of Standard Chartered Bank to discuss once again the key takeaways from the US FOMC minutes and what holds for the bond and the rupee market.